Welcome everyone to the latest edition of the Shaw & Partners monthly video update. Now it's now early October, the year is flying past, we've welcomed spring in and it's also the last quarter of the calendar year. And I think we mentioned last time that this is often a time of sort of softer market returns, but that wasn't really the case, with September displaying a continuation of the momentum that we've seen in share markets since that weakness back in March and April earlier this year. So, how did market returns look in April? Well, the answer is mostly pretty positive. And I want to start with the local share market. Look, because not only did it have a good month with the benchmark NZX 50 index gaining 3%, but it climbed ever closer to the previous all-time high of around 13,500. And without wanting to steal too much thunder from my commentary next month, in the first few days of October, it did make an all-time high. And it's been really hard going, though. Many offshore markets have recovered to their previous highs much more quickly than our little local index, but we got there. Australia was a bit of an outlier. Now, the ASX 200, the benchmark, it fell 0.8%, but it's had a really strong last 6 months, in which time it's delivered just under a 15% gain. Global markets, though, really did ignore those historical norms of a softer September, especially emerging markets. The MSCI Emerging Market Index gained 7.1% over the month. That's a really substantial lift. And then we have the NASDAQ index. It was assisted by strong returns in large mega-cap US companies. It also had a great month. It gained 5.5%. And the broader global index, the MSCI All World Index, it came to the party too, posting a 3.6% gain. But we can't talk about markets right now without mentioning the gold price. It surged and really started to threaten that $4,000 an ounce level. And I think the really interesting question is just why? Well, there are several reasons. Firstly, there's the prospect of lower US interest rates, and that reflects the likelihood that the Federal Reserve will continue to lower the Fed funds rate. Now, the Fed funds rate, that's the US equivalent of our OCR rate. And gold tends to benefit when the Fed funds rate falls because the cost of owning gold falls with falling shorter-term interest rates. And in the short term as well, the gold price is reacting to concerns about the future of the US dollar as the global reserve currency. And this is all tied up with rising US fiscal deficit, the volatile US political landscape, and to some degree, inflation risks as well. And also in the background, there's been pretty strong central bank demand. So the Chinese central bank, Russia and India, they've all been consistently lifting their gold reserves, again reflecting concerns over the future of the US dollar. Now, at the same time, US financial markets have had to deal with the prospect of a looming US government shutdown. Now, the potential outcome, it was brewing towards the end of the month, and a shutdown was initiated in early October. And that happened because the Democrats and the Republicans failed to reach agreement on budget allocations for the upcoming year. And the key issues there are things like healthcare subsidies and access to healthcare insurance. Now, US government shutdowns, they haven't historically rattled share markets, but the duration of the shutdown is important. And we have to note that the previous longest shutdown was back in 2018-19, when the government was shut down for 35 days. And who was in charge then? President Donald Trump. Now, we can't talk about share markets either at the moment without talking about AI. AI is everywhere, and the role that AI is playing. Now, there are pockets of irrational overexuberance in AI-related areas. It's been estimated that over 2026, the Mag 7 companies, they're going to lift their capital expenditure to approximately $500 billion US dollars, or if I use more colourful language, that's $500 billion. And at the centre of that spending is AI-related expenditure. Now, valuations of AI-related companies, they have surged. OpenAI is the poster child for this, and there's plenty of talk about an AI bubble. I agree, there's massive expectation built into some companies that are riding the AI train. And look, there are going to be winners, there are going to be losers. I mean, in this horse race, some horses won't make the finish line. But we're very mindful of this when we think about our portfolio global share market exposure. Look, I'm hearing lots of comparisons being made to the tech boom of the late 1990s. And look, there's certainly similarities, but there's also important differences. And I would make the observation that those Mag 7 companies that are investing hundreds of billions of dollars into AI. They have very strong balance sheets. They are powerful franchises. They've got huge market shares. And while there is the distinct possibility they don't get the return they anticipate from the AI spend, my view is they would all survive the AI asset price bubble bursting. Now, the US Federal Reserve also met over the month and they dropped the Fed funds rate by 0.25%. This move was widely anticipated. They also signalled that another couple of cuts could come around before the end of the year, although inflation data over the next couple of months will have an influence over whether that actually eventuates. Now, technically, this is a September report, but I have to say a few words about the cut to the official cash rate in New Zealand, even though it occurred in October. I was a strong advocate for a 50 basis point cut in the OCR, and that is what the RBNZ, the Monetary Policy Committee, delivered. It really came down to them front-loading the policy direction that they signalled back in August, and that now leaves the official cash rate at 2.5%. Now, inflation, it's running close to the top end of their target range, and it may even pop its little head over the 3% upper boundary, but the bank does see that inflation moderating in the first half of 2026, which isn't that far away. Right now, the issue is that there's quite a bit of spare capacity in the New Zealand economy, and that spare capacity could very well moderate price pressures, so that would see inflation eventually subside. And the central bank has to make that judgment call now. So they've got to make that call to adjust their policy settings to try and prompt some activity. And to do that, we need a bit of a confidence boost. And in my view, the 50 basis point cut is a step in the right direction. They're trying to avoid excessive caution amongst businesses and households. So now we have got lower interest rates. Some mortgage rates are available under 5%, but the currency has paid the price. It's much lower against the US dollar. This is great news for our exporters, but it does increase the risk that import prices climb. It's also increasing that old headwind for investors as term deposits continue to trend lower. Now, we've talked about this quite a bit. And look, there are options for investors. There's other assets we can use to generate income. And if you come and have a chat to us, we can help you with that decision-making process. And I think I said in the last video that we're dealing with a very dynamic macroeconomic backdrop, and our role is to react to that from an investment perspective, and that's very much still the case. We've continued to keep our asset class positioning pretty consistent. We're slightly favouring what we call growth assets, and that's evidenced by an overweight exposure to domestic listed property and a bias to Australasian equities. We're highlighting those global funds that have diversified exposures. We continue to be a little bit cautious in the short term around exposure to those big Mag 7 companies. Now, we thought that domestic listed property assets would get a fillip. They get a boost from a lower than expected cash rate. And it's a sector that we thought would receive further focus with these lower interest rates because it just reinforces the unattractiveness of term deposits. Well, that has transpired. It was a good call. In the September quarter, the NZX property index gained 15%. We are now very focused on managing the global equity exposure of our portfolios, and at some point, we believe that some focus should definitely shift away from those US mega cap and into other global equity sectors, and that's an active discussion we're having at the moment. But look, financial markets, they're continuing to deliver attractive returns, and if you'd like some guidance on how to participate in the financial markets, consistent, of course, with your investment objectives, your risk tolerances, why don't you get in touch with us and we can help you navigate which are now quite challenging markets, and we'll bring our decades of experience to assist you in providing for your financial future. So you can look us up, shoreandpartners.co.nz, or on Facebook or on LinkedIn. We'd love to hear from you.